Good morning. Welcome to the Fig Securities Make Your Cash Work Harder seminar. It's an introduction to fixed income. My name's Elizabeth Moran, and with me today is Cameron Window, who is an Associate Director of Fixed Income Sales in the Brisbane office and sits just outside of where I work, so we're colleagues. Today, I'll just run through a bit of housekeeping first. On your screen you should see an orange arrow. If that's not expanded, if you click on that, there's a panel there and it will expand, and you can see down that panel there's an area for questions. So if, as we're going through today, you'd like to ask a question, just type it in there and we'll try and address it on the way through. Okay, so without further ado, let's get the presentation rolling. Sorry, slight technical hitch here. Okay, first slide's just a disclaimer. This basically says that FIG can only offer general advice. We can't offer any personal advice. Now, if at the end of the presentation you think that you would like to discuss a portfolio with us, we'll make some portfolio suggestions to you, but in no way you're obliged to accept those suggestions. You can come back to us and say, no, I don't like this bond, or I want to buy more of this bond. So in that way, it's your personal choice about what bonds you purchase. We'll have research and a whole lot of information backing up why we think they're good suggestions, but it's up to you and to take into your consideration your own circumstances. This first slide looks a little bit complicated. I'm going to start with that panel about 3/4 of the way down, and it's got 2010s there. That's now, so the 2010s refers to the decade. So at this point, people expect to not work for about 23 years before they start to work. Then they have roughly a 35-year working life, and after that working life, you'll see there's a 24 years and 10 years. So 24 years is now the expected retirement period for people, and that can be longer, of course, depending on how long you live. So it can be up to sort of 34 or plus years. So what this is saying, and what our research shows, is that from the start of the century to now, our working life's shortened. Years ago, people started working full-time when they were 12 or 13, and they worked till they died. There was no retirement, or they just worked until they stopped, basically. And then as the centuries progressed, people have not started work. It's taken them longer to start work, that we're living longer, retirement's growing, and we need to preserve capital and income for those retirement years. So that sort of explains that panel there. Now, if we go to the top part of it, you'll see there's 3 stages. So we're looking at asset allocation during our lifespan. Now, while we're working and we're fairly young, we obviously want to grow the assets that we have, so we look to have a fairly high allocation to growth assets, being shares and property, roughly 70%, with 35% shares, 35% property, and 30% fixed income. But as we get older, we need to transition that portfolio allocation to take into account the growing asset base and the fact that we don't have the time to make up if things go wrong. So if during the GFC, or when the GFC hit, I'm sure you knew people that had just retired and they had a lovely big nest egg, and all of a sudden it was worth half of what they thought it was. So by transitioning your portfolio allocation to be more defensive and include more fixed income, you're actually protecting that capital and protecting your retirement years. So the transitional phase, really, you're moving from that 30% fixed income to, in that final post-retirement, 70% fixed income. So it's a moving feast there. But we actually term that period of roughly 10 years before retirement until about 3 or 4 years after retirement as peak wealth. So this is when you have amassed the most assets, and this is when you really need to be careful and thinking hard about how you allocate your assets. Okay, we'll move to the next slide. So David Murray just very recently, in fact a couple of months ago, said in light of falling interest rates, some conservative investors were considering high risk options like shares in order to get a better return, which is a mistake. Those close to retirement should instead allocate more of their superannuation to fixed income assets like bonds or term deposits rather than shares or property which come with higher risks. The important thing to understand is that as you approach retirement, you have to consider very carefully where your asset mix lies, because the closer to retirement, the more fixed income should be in your portfolio. So I think this sort of fits in with our theme today, just discussing portfolio allocation and getting you to think about the fixed income asset class and allocating to it, and the sorts of protections it can provide to you and your family over the longer term. So this is a fairly basic slide, and it talks about risk and return. So you see on the two axes, on the bottom is risk and on the vertical is return. So as you take on more risk, you expect higher returns. It's a key investment principle. So down the bottom left-hand corner you have term deposits, where you have that known income and known maturity date, and as you move out that curve you'll see bonds sit next to term deposits in terms of risk and return, then hybrids, properties and shares. So bonds are very similar to term deposits in that you have a maturity date and you have a known income, but you are lending your money to corporations. They can also be banks and governments, but they have set terms to maturity and you have known income. So in that way we say bonds are the next best investment to term deposits. As we move out that risk spectrum, the hybrid sector there, with hybrids you don't know of the maturity date of most hybrids. They have a call date, which is the first opportunity the company or the bank can repay you, but the final maturity date can be extended and can be quite a long time. I think the recent Crown notes had a 60-year final maturity date. Also with hybrids, your income can be foregone. There's a term in most hybrids that's non-cumulative. That means the company or the bank can decide not to pay income and there's no drastic repercussions for the company. If you compare that to bonds, if the company that issues the bonds doesn't pay your income, that's then an event of default and there are serious repercussions for the company. Moving out again on that risk spectrum, you have properties. Of course, properties are great, have been great investments for many Australians. The problem with properties is the liquidity of them. It's not easy. They're not easy to sell. They can take a while to sell. You may have to drop your price to achieve a sale. There are other issues, but liquidity is the main one there. And going right out, top of the risk spectrum are shares, but you're taking on more risk, but also with these investments you do expect higher returns. So you expect higher risk and higher return with shares. So corporate bonds, they're drivers of change. Why are investors attracted to bonds? Because there's a big range of risk and return in bonds. You have very low risk government bonds, for example, moving right out to high risk corporates. So that sort of return bracket at the moment is from about 2.5% for government bonds right out to sort of 8% plus. I've even seen 10% just recently in corporate bonds. But of course that goes over a wide risk spectrum. But what you can do is look for bonds slightly higher risk than your term deposits and earn a higher income. They are less risk than hybrids and shares, as we've just talked about that risk-return spectrum. Bonds are great for diversification. There's lots of big international companies that issue bonds in Australian dollars. So those companies aren't listed on the ASX. You can invest in those companies and improve the diversification of your portfolio. Also, there's Australian ventures that aren't listed on the ASX. We have some infrastructure assets like Dalrymple Bay Coal Terminal that isn't listed on the ASX but is an attractive diversification for your portfolios. And finally, just I make quick mention that you can also buy foreign currency bonds, which a lot of big Australian companies will issue bonds in Great British pounds or euros or US dollars or Canadian dollars. So if you have businesses or funds sitting in one of those countries earning very low rate of return, foreign currency bonds might be something that you might consider. Bonds actually protect your capital, and that's one of the attractions of the asset class. When a bond is first issued, and that means when people first invest in the bond, it then starts to trade in the secondary market. It's a big wholesale secondary market. It's not the listed ASX market. But that means you can buy and sell bonds, and the price will go up and down of the bonds. But whatever happens to the price over the course or the life of the bond, typically at maturity you would expect to be returned that initial face value of the bond. So most bonds are issued with $100 face value at first issue. That price of them will go up and down over time, and then at maturity you'll be repaid your $100, just assuming the company continues to operate. So that's a definite positive and a big feature of the asset class, and why a lot of people will choose to invest in fixed income. Bonds are now available in much smaller parcels than they used to be. They used to be only available in $500,000 parcels, and largely then were only accessible to big wholesale or institutional investors. But Fig has made bonds available from just $10,000 per bond. So you could invest the minimum of $50,000 and have 5 bonds in your portfolio. But why are companies issuing bonds? A number of reasons. I think one of the main ones is that during the GFC, companies that only had one banker were put under pressure to repay debt or reduce their overdrafts, and they recognise that they need to diversify their sources of funding. It's not just as we want to diversify our investments, diversifying their sources of funding helps protect them if anything goes wrong or another major event hits. Also with bonds, they can extend the length of loans. With new Basel III requirements coming in, APRA is requiring the banks to hold more capital against loans, so it's more expensive for them, and they don't, the longer they have the terms of the loans, the more capital they have to allocate. So with a bond, they can extend the length of their borrowing. Companies can extend the length of their borrowing as well. Cam, how are we going? Have we got any questions?
Not as yet that I can see. Carry on.
Okay, great. Please, if you have any questions, just type them into us and we'll answer them as we go along. Okay. This is another graph that's widely used in the financial markets, and again, it's risk and return, but we're talking about standard deviation, so the risk of the return not being what you expect it to be. So there's a very low risk with term deposits that the return isn't what you expect it to be. But bonds with their range of risk returns, for a slightly higher risk, you can increase your return. It's more efficient without taking on a much higher risk as in shares. So it's just that you're taking on slightly more risk but getting a much higher return. Your increments higher than going right the way out on the curve. So a bit of a snapshot about corporate bonds. You'll see quite a lot of familiar names, brand logos there. All of those companies issue Australian dollar bonds. So NAB, all the major banks and the regional banks issue bonds. Suncorp, also big foreign banks, Morgan Stanley, GE Capital, which is also qualifies as a bank, they all issue bonds in Australian dollars. But you'll see also there some very familiar domestic corporations, Telstra, Woolworths, Origin, Sydney Airport, they issue bonds. And there's a little logo there, AXA, which is a large French insurer, personal and life insurer. They have Australian dollar denominated bonds as well. But what is a bond? A bond is just a loan from you to the company. They're borrowing your money, and because it's a loan, they're obliged to pay you interest income and return the capital at maturity. So that's a really important that it's a legal obligation. The corporate or the global bond market is roughly double the size of the global equity markets. And big issuers, of course, are governments, US government, Australian government. They are big issues on the global market, but there are many, many corporations that raise funds through bonds in that global marketplace. Now, investors in USA and Europe allocate much more to bond investments than we do here in Australia, and on average they would allocate over 20% of their portfolio to bonds. Again, it's that comfort in terms of knowing when you'll get your income and that your capital will be returned at maturity. That they're the two main reasons that people invest in bonds, as well as the diversification argument as well. In Australia, self-managed super funds hold on average less than 1% in bonds, much lower. We think in part that's because they're harder to access. They've been harder to access in the past, but that now with Fig making bonds available from just that $10,000 mark, and we've seen also seen a few bonds listed on the ASX, people are starting to understand that there is this other asset class that they should investigate. How do bonds differ from shares? As I mentioned earlier, bonds are just a loan from you to the company. You then act as the banker, so you're lending your money, and in exchange you will get that income. Now, there's three types of bonds which I'll go to in a minute, but the fixed rate bonds pay half yearly income, and the floating rate bonds and the inflation-linked bonds pay quarterly. So you're getting a much more regular payment than you would with, say, like an annual term deposit where you just get payment at maturity. This actually allows you to use that money sooner and to reinvest and compound your returns. Now, the bonds are guaranteed by the company unless they go into wind-up. So they're low risk, they're typically low risk, and the shares are higher risk in that you are the owner of the company. You take a part ownership in the company. And we all can appreciate that the bankers get paid before the owners in the event that something goes wrong. But in terms of shares, you buy the shares with the expectation that they will grow. The dividend will grow and that the share price will grow, and that's how you're going to make your money. So your expectations are slightly different to bonds, because as a bond investor, what you want to make sure is that the company's still going to be around at the time the bond matures. So what you do, or what you need to do if you're investing in bonds, is ask yourself, is this company still going to be around when the bond matures? And I like to call that the survivability of the company. Are you confident that the company is going to survive? So it's survivability of bonds versus the expectation of growth in shares. And I think that's actually an easier, like bonds are an easier equation to work out. You know, a lot of companies have long histories, and you've seen them go through cycles. You know that they can maneuver or last the distance, if you like. So I think that survivability question is an easier question than the growth. And we've seen just in recent days, you know, some of the shares hammered by the market. Woolworths comes to mind with its latest announcement to cut staff. With shares, again, there is no guarantee of a dividend or payment or return of capital. You have to sell to get your money back. And I'm not sure if you remember, but during the GFC, all of the major banks cut their dividends. NAB and Westpac, NAB and CBA cut by about 12.5%, but ANZ, I think, cut by about 25%. Macquarie Bank, if you had those shares, they cut by a whopping 46% their dividend. So it's not, there is no guarantee of dividend income. It's moving along unless we've got any questions.
Liz, we've got a few questions filtering through now, so I might take some time to give Liz a break and answer some of these. The first question here from Kenneth is asking what are the implications towards bonds when interest rates are increasing. It really depends upon the type of bond that you're invested in, and I know that Liz will cover off on those different types, but how a fixed rate bond behaves to interest rate movements is different to how a floating rate bond or inflation-linked bond might work. So we will come across that, but there are different types of bonds that will perform differently in different rate environments. Paul asks about risk to Fig. So if you're investing through Fig, is there risk? Do you have any exposure to Fig, or is it merely to the credit provider themselves? And the answer to that is you have no risk to Fig. Fig is a licensed custodian. We're licensed by ASIC. Our sub-custodian is JP Morgan, who is also our bank. So in the event that Fig ceased to exist for some ungodly reason, your bonds would be in safe custody with JP Morgan and not be impacted whatsoever. Robert asks about what percentage of a portfolio would we suggest for a retiree in bonds? I think Liz will come to that, but I think what we can say is that over time, the percentage that should be in defensive assets like bonds should increase over time, particularly if you're no longer working. If you're retired, you can't afford to replace losses of capital. Your capital really is what is going to generate your income. Without that, you lose your ability to derive an income. So I would have thought in retirement stage that fixed income, being bonds and cash, should be upwards of 50%. Back to you, Liz, for now.
Thanks, Cam. It's good to get some questions coming through. Please feel free to ask some more. This next slide, Qantas bonds versus shares. So in recent years, Qantas shares really haven't done very well and reached a low of less than $1 not that long ago. They've done better recently as the company started to turn around and indicate, back to reasonable level of profits. But there's a number of things with Qantas bonds which we have liked since they were first issued. The number one thing is that we've thought that Qantas would survive. We really didn't imagine that Qantas wouldn't be around at the maturity dates of the Qantas bonds. And there's a number of reasons we thought that it would survive. The first was that it had a large amount of cash on its balance sheet. Now, I appreciate with a large company that can disappear quite quickly, but that did add comfort to us that Qantas was a survivor. It also has quite a few assets that are unencumbered. There is no debt on those assets, of course, being the planes. It's issued US dollar denominated bonds, so that's a much bigger market, and it's been a fairly regular issuer there. So US investors understand Qantas and are happy to invest in it, so we think Qantas, if it needed to, could go back to the US and raise further funds by issuing US dollar bonds. Now, Qantas has three bonds available. There's a 2020, which has a yield to maturity of around 4.7%. That's available to retail investors. There's also two others, a 2021 and a 2022, and these are slightly different. So you can appreciate the longer the term of a bond, the more risk there is. So the 2020 is the lowest risk one, and then the 2021 is then the next risk one, and the 2022 is the highest risk one, and you should be being paid more for taking on more risk. But the 2021 and the 2022 bonds have this clause where if Qantas's credit rating was downgraded, the coupon or the interest paid to you would increase. So that's sort of they're different to that 2020 bond that doesn't have that clause. Now, the rates available on those bonds are around 5 to 5.5%, and the 2022 bond has just become available to retail investors. The 2021 bond will become available to retail investors in the next month or two. So with that, we think Qantas is a survivor. We're comfortable investing in Qantas bonds. With the shares, the story over the last number of years hasn't been so positive or assured. In fact, Qantas hasn't paid a dividend for the last 5 years. So if you had invested in the shares for income, it would not have done what you'd hope for it to do. Of course, the share price, if you'd invested at that low point of under $1 and it's now approaching $4, you'd be pretty happy. I guess the point to highlight here is just that bonds provide that known income and return of capital at maturity, and shares just do not have that certainty. A couple of bond facts that we think are worth highlighting, and there's quite a few more than this, but these are the main ones. So the Australian dollar bond market, the Australian dollar market is worth approximately $1 trillion. It's made up of a number of different companies or entities that issue bonds. The largest is the Commonwealth Government, which has about $360 billion of bonds on issue. Then we have all the state governments and territories issue bonds, and then so do corporations and foreign institutions. Now, this market, or that $1 trillion market, the vast majority is traded in the OTC or the over-the-counter market. It's not traded through the ASX. The ASX has a very small percentage that it trades. So really, to tap this market, you need to find a broker such as Fig. Now, bonds can be sold prior to maturity. You don't have to hold them for the length until maturity date. We have some very long dated bonds out to say 2035, 20-year type horizons, which a lot of our investors go, well, actually I wouldn't buy that because I don't think I'm going to be here. That doesn't matter. Bonds are generally easy to sell, but they're quite easy to transition as well. So if you're thinking about your estate, they're fairly easy to transition. There is also an opportunity for capital gain or loss with bonds. So once they're issued and they start trading in the secondary market, the price will go up and down. So you can buy at a low price and sell at a high, which is over and above the income you expect to earn on the bond. A good example here is Stockland. Stockland issued a bond quite some time ago when interest rates were high. It was a fixed rate bond, and the interest when it was first issued was 8.25%. So Stockland they must pay that 8.25% until maturity. That's the contract it made with the market at that point. So the only way that bond or the changing interest rate market can be reflected in that bond is for the price of that bond to change. So that fixed rate bond issued at $100 is now worth about $122 or $3 if you wanted to buy that Stockland fixed rate bond. Now, you'd only ever get $100 back, but in terms of how you should think about the bond, you're getting more of your return along the way through that higher coupon or interest payment. And at the end, you get your $100 back. So the yield to maturity incorporates two things there. It incorporates the income, but also the price that you paid for the bond and the expected price you get, or the $100 you get at maturity. Now, if you need to sell prior to maturity, that's when you could incur a loss. Or equally, if the company went into a wind-up or defaulted on its assets and it started to have to sell its assets, that's when there's the chance of a loss. But this is quite a low-risk event, and in fact, in the investment grade world, if you like, investment grade Australian dollar denominated bonds, only 3 have ever defaulted. They are HIH, Pasminco, and Babcock and Brown International. So it's been quite a long time since that last investment grade default. And finally, the global best practice suggests that superannuation portfolios should contain between 40 to 50% of bonds and should increase over time. A few years ago, the OECD did a study of 29 countries' pension fund allocations, their portfolio allocations. So you can imagine this was a very large study and incorporated pension funds from all 29 countries. So what the study found was that Australians had the highest allocation to shares and the lowest allocation to bonds. And we think that's really because most people don't understand the benefits that bonds bring to your portfolio. What is also interesting is that Australian portfolios had the highest allocation to cash, and that's because Australians have thought of cash as their defensive assets. They haven't incorporated bonds into their defensive way of thinking. Now, the 29 countries, the average allocation to bonds from all countries to pension funds was 53%. Big difference, and that's mainly because pension funds, a lot of international pension funds have defined benefit conditions where they must guarantee a certain payment to those investors in those superannuation funds. So the company takes the risk, not the individual, whereas in Australia it's very much the individual takes the risk and not the company. So then the company or the superannuation providers, their best way to attract new investors is to advertise their high returns, when often high returns mean greater volatility and less surety. So a big difference there. Superannuation funds, globally, those pension funds have a much bigger allocation to bonds, and that's because they have that known income and the known return of capital, and that then allows them a better chance of providing for those investors when they retire. Here's a little tip for you. We talk generally that we think investors should think about owning their age in bonds. So if you're 70, for example, we'd suggest a 70% allocation. And of course, if you're much younger, if you're 30 or 40, you have time to make up any losses. You're trying to grow your asset base. You would take on a bigger allocation to growth assets and a lower allocation to defensive assets. I have seen a few instances where young people have made a lot of money early on in their careers, and I'm thinking here of sports people. They've made lots of money playing AFL or rugby league or tennis, and then they're not expected to have the sort of length of career and the income over their lives that the rest of us do. So in those instances, you know, we have investors who are young and who do invest quite substantial proportions of their allocation in bonds. Okay, here we go. Here's the three types of bonds that Cam was talking about before. The first is a fixed rate bond. And I was talking to you earlier about Stockland. That's a good example. So fixed rate bonds, that Stockland bond pays interest of 8.25% per annum, but that interest is paid half yearly, so it's for every $100 it's $4, 12 and 12.5 cents. So you have that certainty of that income and you can plan around that. Fantastic for retirees and anyone wanting to build a cash flow. So fixed rate bonds, as I mentioned, their prices go up and down quite a bit depending on economic conditions. So high interest rates are a great time to buy fixed rate bonds, lock in that return, and then as interest rates come down, as we've seen over the last few years, the prices of the bonds rise and the return available to investors in the secondary market, it comes down. Now, there's a number of other reasons why you would still buy fixed rate bonds at the low point in the cycle, which I think we're getting very close to now, but that is that they're completely certain, that income's certain, and also it typically is higher than floating rate bonds of equivalent sort of maturity dates. So you have that certainty for longer. There are strategies around buying fixed rate bonds in low rate markets. Of course, interest rates still might be cut. So depending on your view, you would buy fixed rate bonds. You would have I think you would always have an allocation to them, but in recent years we'd advocated high allocation to fixed rate bonds. I think if you were an existing investor in bonds, you might start to think about reweighting your portfolio towards more floating rate bonds if you think interest rates are at the low point. So floating rate bonds work in almost the opposite way to fixed rate bonds. If you think of a boat on the ocean and the tides, a floating rate bond, the income you earn will go up and down with the economic environment. So it goes up and down, and it's set to a variable benchmark. So the interest on bonds and when they're very first marketed or issued, there's a rate, they're quoted as a rate over the benchmark. So it's normally bank bill swap rate, which is variable, plus a fixed rate margin. So if you had a bond issued a few years ago at BBSW plus 3%, and BBSW at that time was 5%, your income for the coming quarter, so it's calculated on the very first day the bond's issued, they take BBSW plus the margin, and that rate then is applied to the coming quarter. When that interest for that quarter is paid, they then take the BBSW or the benchmark rate on that next date and apply the same margin. So if interest rates or BBSW had come down over the quarter from 5% to 4%, then the interest for the coming quarter would be 4% plus the 3, but then of course you have to do the quarterly calculation, so it's not an annual payment, it's divided by 4. So those floating rate bonds, because the interest income is always adjusting to what the market's expectations are of interest rates, the bond prices don't move as much. They're much more stable. So that's part of the benefit of those bonds. If you think you might want to sell prior to maturity, typically the prices are more stable. But on the other hand, if interest rates come off, you can make big gains on the fixed rate bonds. And lastly, inflation-linked bonds. These are very interesting, and I think really where, if you're new to bonds, this is where you should first look, because they're the only security that offers 100% hedge against inflation. So they work similarly to the floating rate bond in that they're marked to a benchmark, and that benchmarks the consumer price index. But on the other hand, they also have a fixed interest or fixed income component, so a bit like a fixed rate bond as well. I'll talk about two main types here. The first is the capital index bond. So these bonds, if you remember, I said most bonds are issued with $100 face value. These inflation-linked bonds are also issued with $100 face value, but each quarter the value of inflation is added to that face value. So if we had an inflation-linked bond was issued a year ago at $100 and inflation over the last year had been 3%, the value of that bond, the face value of that bond would have risen to $103. So that if that company had to repay you tomorrow, they would owe you $103 and not $100. So that's how they work. We have Sydney Airport issue 2 of these bonds, a 2020 and a 2030, and the 2020 bond, the capital value of that now, Cam, do you know what that is?
Of the Sydney 30?
Yes, Sydney 30.
To market. Capital value is around 123.
Okay, so that's if Sydney Airport had to repay you tomorrow, that's the amount that you would earn. The benefit of these bonds is that fixed income on top of the fixed interest payment on top of that adjustment for inflation is paid on the growing face value. So if you have a set 3% margin, when it's $100, you're getting a $3 return. If that $100 grows to be the $123, that 3% interest is then calculated on the higher face value of the bond. I'm hoping that makes sense. If it doesn't, please type in the question and we'll have another go at explaining it. The second inflation-linked bond is called an index annuity bond, and again these work completely differently to the capital index bond. You would invest a lump sum up front into these companies' entities, into the bonds, and then the company then returns you quarterly principal and interest. So it's returning your principal over the life of the bond. So principal and interest, they're great for cash flow if you're in retirement and you're happy to use some of that capital, to live. So a good example here is the Melbourne Convention Centre. They have one of these index annuity bonds, and its maturity date is very long-term to maturity of 2033. And I looked at one just recently, and you get very attractive cash flow, principal and interest over the quarterly over the term, right to maturity. So you have that certainty. There's a base rate calculation there, and inflation's added to that base rate calculation. If you want more information, we can certainly send it out to you. Okay, here is the most important diagram of the presentation, I think. It's a simplified bank capital structure. What it shows is the priority of payments should a bank go into a wind-up or a liquidation. So you can see it's sort of like rungs on a ladder. The top rung is the lowest risk investment, and it is repaid first. So you can imagine if assets are sold, the receivers have income or cash, they pay out first, that top rung. And that top rung must be completely repaid before the next rung's repaid, and so on till you get to the very lowest rung, the shares, where the opposite is also true. So as losses are encountered, the shareholders are in the first loss position. So as a shareholder, you are taking the highest risk in the capital structure. I'm just going to click here and show you where the bonds sit. So bonds sit at three positions in the capital structure. They sit at the very highest level, the senior secured debt or covered bonds, as they're known for banks. So with a bank covered bond, they set aside 8% of their mortgage loan pool, and those mortgages secure the bonds. If anything happens to the bank, those investors are paid out of that security and they're repaid first. No one else can touch that mortgage loan pool. We come down to term deposits. They're a very low risk investment, and there is the government guarantee, but that does sit outside the bank's own capital structure. And term deposits have that maturity date and the certainty of income, but there is no defined security, if you like. There's no mortgage pool, or there's no property or whatever it is securing those term deposits. So we're coming down the capital structure now, and we're taking on more risk. So the next level is senior unsecured debt, or senior bonds. They sit just under term deposits in the capital structure for banks. They are generally low risk investments. Typically for banks, banks issue senior debt for 5 years, and it can be fixed or floating or inflation linked. And you have certain income payment dates. So you have that certainty and you have the maturity date. Albeit there is no defined security as such, like there is with the senior secured bonds. Coming down the structure a little bit more, we get to the subordinated debt or subordinated bonds. These typically have longer terms to final maturity. So with the banks, it's out to 10 years is the final maturity date. So the risk there is that as there's longer terms to maturity, there's more uncertainty, you're not so certain of the bank's or the company's position, you're taking on more risk, and you are paid more, you should be being paid more. But with subordinated debt in the past, with banks, they've had a call date, which means at a certain date, typically after 5 years, the bank can repay those bond investors. It's not obliged to, but it can. And the senior banks in Australia have always paid after that 5-year first call on that subordinated debt. Not all the banks globally have, and the risk there that they take is that the market, next time they want to come to the market says, well, we don't trust that you're going to pay us at the first opportunity, and you have to pay us more to issue that debt. New bank subordinated debt has what's called a non-viability clause, as do the hybrids that sit underneath. So at APRA's discretion, who is the regulator, APRA can say, well, I think you guys are non-viable, and under that clause, subordinated debt and hybrids both convert to shares. So they convert to shares to top up capital and support the more senior investors in the structure. So they want this bank to survive, so they're supporting the bondholders and the term deposit investors and the secured bondholders, their positions. So there is that clause where here you're starting to look at risk and return. Am I being paid? The question you should always ask is, am I being paid enough for the risk I'm undertaking? If we move down to hybrids, hybrids have, of course, the call date similar to subordinated debt, but we've seen up until very recently, the banks have been extending that call date out to that first call date out to about 8 years, which again they're asking investors to take on more of the risk, and most of the hybrids now, if they're not called, within their call structure, they become perpetual, which means for you to get your money back, you have to sell them, and then so that you then take on the risk of what the market price is for those investments. So hybrids have much longer terms or perpetual status in terms of maturity. They also, the banks now can not pay income without any serious consequences. So they can actually forgo income to investors. So while bank hybrids are often sold as good income propositions, and I think mostly that they are, because they're higher risk structures and can be converted to shares, you're taking on more risk, much more of a share-like risk without the upside that the shares might have in terms of higher prices and higher dividends. One other thing with hybrids, they have another conversion to shares clause, and it's called a capital trigger. So if the bank's capital falls below 5.125%, then hybrids automatically convert to shares. One of the things with that sort of structure is that there are no guidelines about how it would transpire. We haven't seen it happen before in Australia where there's that conversion. So if for any reason APRA defined a bank as being non-viable, or the bank hit the capital trigger clause, and we do think the capital trigger clause would happen first, the value of the shares then would be plummeting. We don't know how long it would take for them to convert your hybrids into shares and when you would then have the opportunity to sell. So the shareholders may in fact have a higher position in the structure if the worst were to happen. Now we've seen just this year really, hybrids have underperformed, and I think that's the market realising the risk involved in them and demanding higher returns. So investors have sold out of listed hybrids, I think probably in largely favour of the shares that have done much better in recent months. Okay, just one other button I'm going to click here and you'll see it comes up. What's fixed income? Fixed income is a large part of the capital structure. So it's all the bonds and hybrid and term deposits. So at Fig, we do have a term deposit brokerage business, and where we get term deposit rates from about 60 institutions every day. So if you're a term deposit investor, it's always worth getting a quote from us. And I found just recently I had a friend who wanted to get a quote from us. He was banking with ANZ, and we got a 25.25% higher return for him. He went back to ANZ. They then have matched that, which it's not surprising, but it's worth shopping around for term deposits. Hybrids, while we don't like the new style hybrids, we do sell some older style hybrids that don't have those conversion clauses in them. So there are still some interesting investments there. I guess in summing up this slide, it's worth thinking about the risk and the return in your portfolio. Do you have enough of a range of investments? A lot of investors will only have term deposit and shares and will miss out on those other rungs in the ladder where they can either take some of the risk off the table in terms of their share portfolio and invest in bonds, or they can get higher returns on term deposits by investing in bonds. Okay, this is how the capital structure translates in the market. We've purposely looked at a volatile, high-risk stress event, the GFC, you won't be surprised to hear, and we've invested $100 in three securities: the senior bank bonds, Commonwealth Bank Pearls, hybrid, and a CBA equity. What we've done is we've added back to each of those lines the income and the dividend franking, if applicable. Well, certainly is applicable to the shares or the equity and the hybrid. So the green line there is a major bank senior accumulation index. So we've actually combined trading of all the major banks to give a smooth line over a long period. Because you remember I said that senior bank bonds typically are only for 5 years. To get it to show you over this period, we needed to have a longer an accumulation index, if you like, which is using all the 4 banks' senior bonds. But you can see it's gently upward sloping, it's very consistent, there aren't any surprises. In fact, you might see a slight rise in the line around March 09. That's because investors were selling down higher risk securities and investing in lower risk protective investments like senior bank bonds. If we go to the mid-blue line, that's the hybrid, and you can see it's a little bit more volatile. And at the low point, March 09, you would have lost about 30% of your capital value if you were a forced seller at that point. The hybrid then recovers, still quite a little bit of volatility. Interestingly, it's never caught the senior bank bonds over that period. And the last line is the shares, the CBA shares, the equity, the dark blue. And you'll see quite a lot more volatility, which is exactly what you would expect in a stressed market. The $100 at the low point, that capital value, you would have lost about 55% of your capital value. Quite a hit to those retirees or those just about to retire in the GFC. The share then recovers. It almost hits the bond or catches the bond in about April 2010, but it actually takes around about 5 years in early 2013 for it to overtake the senior bank bonds in terms of total return. So a couple of things here. I think the big one is volatility of high risk investments, and that you need to invest in a range of risk and return assets to protect yourself. So had you had Commonwealth Bank senior bonds over that period, you could have sold them if you needed the money and waited for the recovery in your shares. If you didn't, if you weren't, you didn't have that capacity, you might have been a forced seller at the bottom of the market. The other thing I like to point out here is that I've been an analyst for many years, and when I look at the Commonwealth Bank on the ASX, to me that is the lowest risk company. So this is what happened to the lowest risk company. You can imagine some of the single ore miners or the mining services companies or development companies, the volatility is much greater. Do we have any questions, Cam, at this point before I move on?
Yes, we do, Liz. I can answer a couple of questions now. So a question that often comes up has been asked by Laura. Laura asks for the difference between a retail and a wholesale investor. This is a delineation which is part of the Corporations Act, so it's legislation that we need to follow here in Australia. Each investor needs to be defined as either retail or wholesale. There are different levels of disclosure depending upon the type of investor that you are deemed. The basic split is based on assets. So as per the Corporations Act, if you are in control of net assets of $2.5 million or above, then that defines you as a wholesale investor. If you don't have $2.5 million net assets or control $2.5 million in assets, you are a retail investor. So there is another way to meet that test, and that's also through income. So if you were earning $250,000 per annum for the last 2 years gross, then you also classify as a wholesale investor. The key differences when investing, as I said, there are different levels of disclosure. There are some bonds which are restricted to wholesale investors only, and credit rating information from the credit rating agencies like Standard & Poor's and Moody's is also restricted only to wholesale investors. So there are a few differences there, and that's something that your accountant will be familiar with and can help you to arrange. Kenneth also asks about bond volatility and recent bond sell-off, or what causes a bond sell-off, or what causes bonds to rally. And really the answer to that is future expectations of yields or interest rates and economic growth. So that is largely driven by government bond yields. So of late what we've seen is a rise in expectations out of the US, and so what we've seen is US treasuries, or those government bond yields, the yields go up, and as yields go up, bond prices go down. It's an inverse relationship. So that's flowed on a little bit through here. So it's really a change in future forecasts around what's going to happen with interest rates that would change the present value of bonds. Okay, Liz?
Great, thanks Cam. Okay, the next slide, this next slide is not one of Fig's, it's actually UBS slide, and it's their composite bond index, and it compares to the ASX 200 accumulation index. So again, these two indices are adding back interest income, and but this graph's a much longer period. So it starts in September 89. Unfortunately, it finishes in September 13. The index, it was UBS, but UBS sold this index to Bloomberg, so it doesn't continue beyond there. But I think it still has a few lessons for us, if you like. So the UBS Composite Bond Index, which is made up of about 70% government bonds and about 30% corporate bonds, is the light blue line here. And you can see it's very consistent, upward sloping, really not too many peaks or troughs. It does interestingly outperform S&P, or the ASX 200 accumulation index, and that period was a period of high inflation and high interest rates, and so government bonds then, when they were issued and they were fixed and offering high rates, they outperformed shares over that longer period. If we look at the darker blue line, which is the ASX 200 accumulation index, you can see the volatility here. So sort of September 02 is perhaps recent or low, if you like, and then there's a steep trajectory up. So it goes from under 3,000 points up to 8,000 points, lovely high. If you bought at the low and sold at the high, congratulations. I haven't met too many people that have, but I do know some. And then of course you get the trough after that peak in about late 2008. It goes up again, and then it's down and up and down and up. Over the long period here, the return on the ASX 200 accumulation index is 10.14%. Over the UBS Composite Bond Index, it's 9.58 or something like that. So the difference over sort of the 24 years of this graph is around about a 0.5% difference in the return. If we go back to that capital structure diagram and we look at where the bonds sit and where the shares sit and the risks you're taking, this isn't actually what you would expect over such a long period. So that leads me to ask you, what's your risk appetite? I think this picture's really funny. I would never eat this hamburger with all that cheese, but her eyes are popping out. She's clearly going to enjoy herself. I think people are naturally attracted by high returns, but it's really important to own a range of assets to protect yourself in a distressed market or a decline or a downturn, if there's a downturn. So I like to say to people, what's your risk appetite? What sorts of volatility are you prepared to endure? Higher risk definitely means an increased chance of loss and that volatility in prices. So you want to protect yourself at the bottom. You don't want to ever be a forced seller, and that's why you would own a range of investments in your portfolio. Lastly, I really like this diagram as well of the surfer on the broken surfboard. I don't know how they've got that. I'm sure there's some smart technology that they use anyway. But the point here being, if you lose capital at the wrong point, it can wipe out your future earnings. If you are just about to retire, you have a lovely nest egg, and there's a big event, and you lose half your capital. I know people that were forced to continue working, or if they'd already retired, they really didn't have the sort of future retirement that they'd planned to have. So on that basis, I'm now going to hand over to Cam, who's going to talk you through a bit more about the processes and give you some tips on some of the bonds that we like at the moment. So thanks Cam.
Thank you, Liz. So just a little bit about myself and my role here at Fig as it compares to Liz's. So my role is as Associate Director in the Fixed Income Sales team, and what that means is that primarily I'm a relationship manager looking after private investors and helping investors to educate investors about how to add value to their portfolios through bonds, setting up portfolios and the ongoing maintenance of their portfolios. Bonds do change in value throughout the term, and they're liquid instruments, so there are opportunities to sell one bond and buy another and de-risk and or improve your position, and that's something that I help private investors, a large majority of whom are running self-managed super funds. That's what I do on a daily basis. So that's the aspect from which I am coming today. Now, in terms of onto the next slide, the question that often comes up, and I think has been asked here online today, is how does Fig make money? So Fig buys and sells bonds externally in large parcels. Now, as a minimum, that's normally 500,000. Sometimes that'll be multiple millions of dollars, depending upon demand from our investors. So because we're buying in such volumes in the institutional market, we're going to pay a certain price for those bonds. So in the example given on this screen, the mark or the price that we might pay might be $99 in the middle there. If you then wish to buy some off us, probably in a smaller parcel than what we've bought it, we will charge you $100, and that $1 difference is how Fig makes its money. Should you wish to then sell on the other side, we might give you $98. This is known as the buy-sell spread or the bid-offer spread. Now, those dollar amounts are not an exact science. It's actually primarily done in basis points. So what we will actually do is buy a bond at a yield of 6% and on-sell it at 5.8%, and the 20 basis points might be how we make our money. So, but roughly translated, it would come out to that sort of level. Those costs cover everything to do with Fig around research, your online capabilities, custody, etc. There's no charge on your account until assets are held in custody, and then there is a small ongoing fee for the custody service through JP Morgan. This equates down to around 8 basis points per annum, which on $100,000 means about $80 a year, and that's just on passing on our costs from JP Morgan. So, but you do need to have a custodian in order to hold bonds. It doesn't need to be our custodian, but any other custodian is going to charge significantly more than that in the market. But that's how Fig makes its money. There's no other ongoing costs. If you were to set up a portfolio today and not want to speak to me for 5 years, then you could do that, and the only fee you would have paid would have been the, aside from the small custody cost, the only other fee is that transactional cost when you bought a bond. So that's how Fig makes money on what we call the secondary market. These are bonds that are trading in the secondary market. The other way in which Fig earns money is through new bond issues, or otherwise known as the primary market. Fig will seek to put entities or companies in touch with our investors and match a demand on both sides. So we will seek to raise money for a particular company, and that company might raise a bond for a variety of reasons, particularly with rates being low as they are. Many companies looking to refinance existing debt at lower levels than perhaps they've had previously. Issuing a bond also gives them greater control over their sources of funding. Banks will tend to only lend money to companies for 2 or 3 years, whereas a company can issue a bond and lock in that money for 5 years, 10 years, 15 years, depending upon the term set. So wholesale investors have an opportunity to buy into new issues on the primary market, in which case that is simply at the issue price of 100. There is no fee for doing that. Fig derives a fee from the issuer in that situation. So that can be a really great way to enter the market. It can be as simple as buy a bond for $100, get a 7% return for 5 years, and get your $100 back. It can be that easy. Fig also administers and brokers term deposits. We work with 25 to 40 different authorised deposit-taking institutions to provide different levels of term deposits, and we'll provide a daily rate sheet highlighting the best rate from 30 days through to 5 years. Point 4 on that slide, there's a new addition to Fig, and this is called the Managed Income Portfolio Service. A bit of a mouthful, we call it MIPS around here, and that essentially is where Fig will professionally manage that portfolio for you. Outside of that, in the standard custodial service, you have say over what is bought and sold, and we'll use our general advice to do so, but the control remains with you. Managed Income Portfolio Service, you're effectively putting an amount of money into that service and to have it invested under certain guidelines or within certain mandates, and we will manage that for you. So as opposed to paying a transactional fee, there is an ongoing management fee for that. I think it's 0.85% per annum. So if you want to have exposure to the fixed income market and still want to have direct ownership, this is not a fund, you still have direct ownership of your bonds, but you want to hand over the responsibility of managing that to the professionals, then you can do so via MIPS. Okay, on to the next slide. So top picks currently, and we've deliberately chosen one of each type of bond. You can see we have one fixed rate, one floating rate, and one inflation-linked bond. Qantas has been discussed today, and it's a wonderful example of how bonds and equities need to be viewed differently. So Qantas has a fixed rate bond with just under 7 years remaining on it, with a yield to maturity of 5.42. So that actually has a fixed coupon of 7.75% and a yield to maturity of 5.42. So that means that bond's trading at a premium to its face value, but it will give an excellent cash flow or running yield of around 7% for the next 7 years. The floating rate note there is from G8 Education. They've been a very successful story. If anyone might know G8, they're an ASX listed company and doing some great things in that space. They have a floating rate note. This is quite short, less than 3 years to run. It pays bank bill swap rate plus 3.90%. So that will move depending upon what happens with the interest rates. So if you are of the view that rates are going to go up, then a floating rate note like this would look attractive to you, because the income that you derive will increase as interest rates increase. So yield to maturity for less than 3 years is 5.43, which is excellent for such a short time frame. Lastly, Sydney Airport. This is a capital index bond, so Liz touched on it earlier. This will compound over time with inflation. So that rate there of 5.77, that assumes a 2.5% rate of CPI. So more accurately, what you're getting there is CPI plus 3.27. So if CPI was to drop to 2, then that return will be a little lower. If CPI was to spike to 3, 3.5, then your rate is going to return. So for anyone who thinks that that inflation is going to break out over time with all this rate cutting and printing of money around the world, if we're heading for an inflation breakout down the line, then the Sydney Airport bond would be an excellent way to go. And as Liz alluded to, there's no other inflation hedge like this in the market.
Cam, I think it's worth just talking there about what happened with inflation in the 80s, you know, when it was over 10% for a number of years. That bond then would pay, you know, income or equivalent of 13%, you know, over time. So if you're a retiree, you spend more of your money or income on consumables which have that inflation component. So and inflation-linked bonds are very protective for retirees in their portfolio. And again, as I mentioned earlier, I think most investors don't have that inflation hedge, and I think it's a good place to start if you're new to bonds and fixed income.
Yeah, certainly. The capital index bonds like Sydney Airport, and there are others, which these are senior secured bonds. These capital index bonds are senior secured. They tend to be issued by infrastructure companies, so they're very defensive, and what they do is give you that inflation protection. And as an example of late, if you compare it to, say, a term deposit now, a 3-year term deposit at the moment might be giving you 3% if you're lucky. Now, if you consider that inflation is 2%, and particularly if you're in a situation where you're paying tax on your income, then you're barely breaking even on that level. Potentially, you could be going backwards. So here, a bond like Sydney Airport, you're going to get an income of over 3%, plus you're getting CPI, so you're sort of getting that as a free kick in what is still a very defensive senior secured asset. So I think for anyone who is in cash and worried about the returns there, something like this is not a huge change in risk for what is a substantial uptick over time. Okay. The next steps, so in terms of logistics around opening an account and getting trading with Fig, register to receive the wire. You may be getting that already. That is our weekly e-newsletter. It comes out every Wednesday morning. Liz and her team work late into the hours of Tuesday to produce some stimulating reading for you on a Wednesday morning. So that's a great way to get up to speed with what's happening in bond markets and to continue your education there. Should you wish to open an account, there is no cost for opening an account, but you cannot buy or sell bonds until you have an account open with us. A bit like opening a bank account or a share trading account. We've got to verify your identity and the validity of your investing account. Once the account's open, and that normally takes us less than 24 hours after we received your forms, you are ready to invest. And the way to do that would certainly be to have a chat with someone on the sales desk like myself from wherever you happen to be around the country. They'll be able to help you with getting your account open and start talking about what sort of bonds you're interested in, what are you looking at from your bond portfolio, how much you're looking to invest, and it really is a back and forth to get the right mix of bonds for you. There are 250 odd bonds available, and you know, it's all about getting the right mix for you. I guess you would look to have a bit of diversification in terms of something fixed, something floating, something inflation linked. That will give you protection across a range of economic environments, so that's a good start. And then depending upon your view on rates, you could weight that one way or another. The other sort of final piece of advice I give people, if you're starting out in bonds, invest as if you're going to hold to maturity. That is the key differential between investing in a bond and investing in a share. You have a known outcome. So when you see that, we'll say YTM or yield to maturity, that's the end result if you hold it to maturity, and that's your known outcome. If you're happy with that number, buy the bond. If you're not, don't. There will be opportunities to buy and sell throughout the term, but you've always got that maturity as a backstop. So invest on that basis. The trading side of it comes later. About Fig. Fig, we are the largest fixed income specialist in Australia. We started in 1998. Here in Brisbane, started by some fixed income professionals who had worked in fixed income markets around the world and wanted to grow the market in Australia where it was significantly underrepresented. So we've been working hard within the legislation and helping to change legislation to open up bonds to private investors. 6 years ago, you could only buy bonds in $500,000 parcels. So it was primarily the domain of investment banks and large superannuation funds. So slowly that's changing, and everyday investors are getting more of a shot at what the institutional markets have been enjoying for decades. We now have over 6,500 clients and joining every month. $11 billion under investment, so that is comprised of around $3 billion in bonds and around $8 billion in term deposits. So that's across private investors, but we also look after a range of corporates, charities, councils, universities, all sorts of different investors coming through Fig. We transact over $1 billion in bonds a month, and we have over $1 billion in offshore bonds. Primarily, US dollar market at the moment, I think has been the area that people are looking at. Liz did touch on foreign currency bonds. If you have money in those currencies, that's great. If you don't, we can help with that. We can do foreign currency through our bank so that you're able to buy bonds in US dollars. If you had a feeling that the US dollar would strengthen against the Aussie, then holding US dollar denominated assets could work to your advantage, because coupons are paid in US dollars and then converted back into Australian dollars and paid to your account. So if the Aussie dollar falls, then the amount you're going to receive is greater. Of course, the reverse is also true. If the Aussie was to ever reach its highs of, what was it, $1.08 against the US, then your income would fall. But that's been quite a successful strategy for some investors over the last 12 to 18 months. We're also now able to order online, so you can buy and sell bonds online. There's a facility to check pricing and buy and sell via our website once you have an account. And as we've touched on, we have the new MIPS, or Managed Investment Portfolio Service, which is the first of its kind here in Australia.
That now really concludes the main part of our presentation, and I'll just give Cam a minute to catch his breath and check and see if there's any questions there. A couple of things I just want to add. There's a lot of information we have for new investors. We have a new website for our wire, and it's www.thewire@fig.com.au. And we're continually uploading articles and news stories to that website now. The email comes out on the Wednesday and summarises most of the things we've done, but that website will enable you to find educational articles or research on specific companies, or any comments we've made on interest rates. There was an excellent article this week about retirement that has been well received, so well worth having a look at that website. Of course, we do webinars fairly regularly, and there is a quarterly expert series that we run, and the next one of those is due just next week, and that's on tax. And Ernest Chang, who is Price Waterhouse tax partner, is coming to deliver that. So we do bring external experts into our business to give information to our clients. We do have an awful lot available. Cam, is there any last questions that we want to discuss?
Final words. Just a couple of questions. One question about foreign currency bonds versus straight currency and fees. There's no difference in Fig's fees there. Fig will make money on the buy-sell spread. We don't make money on the foreign exchange. We're not licensed to give foreign exchange advice or operate in that market. That's simply done through our bank, and they take a few basis points, but get excellent exchange rates through the bank. Chris has asked about buying and selling bonds online once registered. Yes, you can, although you will find if it's your first trade, it does need to come through a person for verification. After that, once you are trading and have bonds in custody, yes, you can buy and sell bonds via the online facility. And Chris also asked, what's the minimum amount needed to be deposited into the Fig account? And the very simple answer there is nothing. You don't need to pay us anything to get started. We don't hold any of your money. We simply link into your existing bank account. So whoever you bank with now, that's fine. You can leave your money there. When you want to buy a bond, we will send you a contract note, the same way you would get if you bought a share, telling you that we've bought the bond, it's going to settle in 3 days' time, and we are going to debit the money from your nominated account on such and such a date. So there is no other money required over to us. You simply give us authorization on your existing bank facility, and we will pay coupons directly back into that bank facility. So I think the next step, really, if you're interested in having a chat further about your own situation and how to get started with Fig, would be to contact a relationship manager in your local areas. That I'm in Brisbane, but we have offices in Sydney, Melbourne, and Perth also. So please get in touch with your local office. Will be the best way to further proceed. Thank you.
Thanks, Cam. I think that just about rounds it up. I want to thank you all for joining us here today. If you have any questions, we're very accessible as myself and the research team as well. If you have any specific questions about companies, we have a lot of information available on our website. Thanks very much for joining us today. We hope to present to you again soon, or that you'll join us again soon for another webinar. But this now concludes